Manulife just dropped its latest quarterly results, and there are some huge numbers and some really fascinating stories kind of buried inside. So, what's really going on with this insurance and asset management giant? Let's dig in and find out. Okay, right off the bat, the headline number is a big one, a record $2 billion in core earnings just for the quarter. That's a solid 10% jump from last year, and it's a really clear signal that, on the surface at least, the business is doing great. But what's actually driving that growth? Well, the company's CEO, Phil Witherington, puts it down to focused execution and global strength. And that makes sense. That's the official story. So now, let's peel back the layers a little bit and see what's really powering that performance. First up, we have to talk about Asia. It is a massive piece of this puzzle. For Manulife, Asia isn't just another part of the business anymore. It's more and more becoming the engine for growth. And this quarter's results really drive that point home. I mean, just look at the scale of the growth here. It's what's so interesting. Core earnings in Asia just shot up by 29% year over year, hitting $550 million. And this wasn't some kind of fluke. It was driven by real, continued business growth and just higher sales across the entire region. And this chart, well, this shows you exactly where their strategic focus is. Manulife has basically pointed to two divisions and said these are our highest potential businesses, Asia and their Global Wealth and Asset Management Division, or WAM. And look at that. Together, this power duo is already responsible for more than 3/4 of the company's core earnings this year. All right, now let's turn to that other key business, Global Wealth and Asset Management, because this is where we find a really fascinating paradox in the numbers. It's a story of record highs sitting right next to a pretty surprising and counterintuitive trend. So, first, the good news. Just like the company as a whole, the Global WAM division also hit a record high for core earnings. They were up 9% from last year. And this was propped up by growth in the markets and some really disciplined expense management. So far, so good, right? But here is the twist. During the exact same period that they were booking those record earnings, $6.2 billion flowed out of their funds. That is a huge swing from the $5.2 billion in inflows they saw in the same quarter last year. So this just leads to the obvious question. How is that even possible, right? How can a business make more money when its customers are, on balance, taking their money out? It just feels like it shouldn't work that way. But there's actually a pretty clear explanation. Okay, so here's the crucial point. While there were net outflows this quarter, the total pool of assets they manage is actually 10% larger than it was last year, mostly thanks to market growth. So they're earning fees on a bigger overall pot of money. You combine that with keeping a really tight lid on expenses, and what do you get? You get expanding profit margins, even with those outflows. Okay, so let's shift gears now from those global growth engines to the company's home turf, right here in North America. And here, the story is much more of a mixed bag. It's really a tale of two very different performances in Canada versus the US. Yeah, it's pretty much a split decision. The Canadian part of the business, it delivered really solid, steady growth. Meanwhile, the US business, which you might know as John Hancock, well, it ran into some pretty significant headwinds this quarter. So in Canada, things look quite healthy. Core earnings climbed to $428 million, and that was driven by solid growth and especially strong sales in both individual and group insurance. Just a very steady, solid performance. The US, on the other hand, tells a totally different story. Core earnings there were down 20%. The company says this was mainly due to a rough patch with life insurance claims. But, and this is a really big but, there's a major silver lining. New business sales shot up an incredible 51%, and that's a powerful indicator for future growth, even if this quarter was a tough one. So when you take all that into account, the strong growth in Asia, that weird paradox in wealth management, and the mixed results in North America, how is Manulife setting itself up for the future? Well, they've actually laid out a pretty clear roadmap for us. The company is rolling out what it's calling its refreshed growth-focused strategy. It's basically a plan to build on its current momentum by doubling down on what's working, while also trying to expand into new areas and just become more efficient overall. The strategy really has three key parts to it. First, they're pushing even deeper into Asia by jumping into the massive Indian insurance market. Second, they're buying new capabilities, like acquiring the U.S. private credit manager Comvest.
And third, they are going all in on technology, trying to become an AI-powered organization and rolling out everything from chatbots to new underwriting platforms.
Now, to really get a feel for their future potential, there's one last metric we got to touch on. It's called New Business CSM, or Contractual Service Margin. Honestly, the simplest way to think about this is like a piggy bank. It represents all the future profits the company expects to earn from the new insurance policies it sold this quarter. And that piggy bank? It grew by a very, very healthy 25%. So let's put it all together. What we have is a company that's posting record profits, and it's being fueled by this powerful Asian growth engine and a really disciplined wealth management division. But at the same time, it's dealing with challenges like asset outflows and headwinds in the US. It kind of leaves us with one final question, right? Will their clear, growth-focused strategy be enough to navigate all the complexities that are definitely still ahead